We've got Peter Schiff right here in the chair with us. He's the CEO and the Chief Global Strategist at Euro Pacific Capital. We wanted to find out, Peter, a little bit from you just regarding what you are seeing this morning in terms of the equity markets. I know you're taking a bit of a longer view, but we basically have the Dow Jones already that is up 6% year to date. What's wrong with that kind of a performance?
Well, I think that if you judge it based on the price of gold, for example, I think the Dow Jones is still down on the year. And I think that's a much better way of looking at it when you're living in a very inflationary time period. But, I think the big news of the day that's driving the markets is the news coming out of the home building sector. And that news is only going to get worse. Home builders are, reducing their forecasts. They're going to be reducing them a lot more. Anybody who's tempted to buy these stocks because they think they're cheap, because they've fallen so much, they're still very expensive. I expect pretty much all of the home price appreciation of the last 5 or 6 years to be erased in this market. And unfortunately, the mortgage debt associated with those purchases will not be erased. In fact, in many cases, because of negative amortization, the mortgages will be larger. And because of higher interest rates and the use of adjustable rate mortgages, they'll be much harder to finance. And I think that's going to be one of the key drivers leading the U.S. economy into a very severe recession. And, of course, that's not going to bode well for corporate earnings in the future. And so I think the slight gain that we've seen in the markets so far year to date will be wiped out by next year. And I think we're going to see a significant move down in U.S. stocks.
When you say about a significant recession coming up, is this over, the next 12 months or further out than that?
I think it's likely to start next year, and I think it's going to last not for quarters but for years. I think, right now...
Why? I mean, why this view? You've got a U.S. economy that's growing at 2.5% right now.
It's not really growing. What's really growing is our consumption. It's being financed by debt. We have a negative savings rate. We've basically destroyed our savings over the last 4 or 5 years. The American consumer has gone on a spending binge, depleted his savings, and, run up a lot of debt based on the assumption of ever-increasing home equity. Once that equity vanishes and people realize the need to rebuild their savings, and people no longer have the ability to cash out money and spend it, and people are struggling to meet mortgage payments that are now much higher because they had adjustable rate mortgages, consumption is basically going to fall off a cliff. And our economy is 70% consumption. A lot of people earn their living in the service sector. You're going to have a lot of unemployment. You're going to have a lot of people just cutting back on any kind of discretionary spending. And it's not just going to be a small decline. You're going to see a very meaningful decline in GNP, and it's going to last for years.
Well, the idea is, though, that you've got unemployment at historic lows. We're still creating jobs. And as long as you're seeing an increase in employment and employment being created, and as long as you are seeing there's actually concern about wage inflation in some cases, and that is likely to continue.
No, but you're forgetting
to shepherd the consumer through.
How much of this employment is directly tied to the real estate market, and how much of it is indirectly tied to the consumption that real estate equity is making possible. And so many people are borrowing against their homes or relying on low interest rates to free up discretionary income. All those jobs are going to be gone. And even though, we do have a relatively low unemployment rate, that's because of the way we calculate unemployment. There are a lot of Americans that don't have jobs, that have given up looking for jobs. And, I think that you're going to see the unemployment rate move up dramatically as the real estate market really begins to decline next year.
Let's take a quick break on that note, everybody. We're going to come right back after this. We've got more with Peter Schiff. We're also going to be joined by, now welcome back, everybody. Peter Schiff is our featured guest, the CEO and Chief Global Strategist over at Euro Pacific Capital. And Peter, we were talking earlier about how pessimistic you are on the U.S. economy, which means you're telling a lot of clients to go abroad and to go overseas. In terms of looking at Asia and moving to Asia, what are the particular areas that you find most interesting there?
Well, we're looking mainly at a lot of the domestic demand plays in China. We focus mainly on China through Hong Kong and Singapore. But I think that, one of the biggest recipients of the loss of American purchasing power is going to be in Asia, particularly in China. Right now you have the Chinese government maintaining an artificial ceiling on its currency. They're not letting their currency rise to reflect the true purchasing power of Chinese people. And what's actually happening is American consumers are actually enjoying the benefits of Chinese productivity while it's being denied to the Chinese. And I think when our recession really begins and the dollar collapses, which is what I'm looking for, purchasing power is going to move east. It's going to move from Americans to the Chinese, and all of a sudden you're going to see this huge increase in demand in China as now Chinese workers can now afford many of the products that right now they cannot afford, and which they instead ship to the United States for American consumption. And so we want to really be focused on the companies that are going to benefit from the increased demand in China, and the ones that are not going to suffer from the collapse of demand here in the United States.
Why is it that China is so attractive and the U.S. is not? These two have been the underpinnings of this entire global move.
Well, I disagree that the United States has been an underpinning. We've been hurting the world. All the United States has been doing is using up the world's scarce savings and blowing it on consumption. And we haven't been
you can argue
producing.
that it's that consumption that is fueling all the gains we've seen in China and in many other parts of the world.
That's putting the cart before the horse. It's the production. The production is what's important. And the reason I like China...
Well, if you didn't have demand, you wouldn't necessarily have production.
Well, demand exists on its own. Demand is infinite. There's an old saying that supply creates its own demand. In fact, you can define economics as the science of how to satisfy unlimited demand with limited resources. And the reason I like China so much is because China their economy is defined by savings and production. And that's the real key to wealth. That's why America became a wealthy country in the first place. It was because we saved and produced. That's what enables consumption. But everybody wants to consume. I mean, little children want to consume. The key is to produce stuff. And right now, the problem is the Chinese purchasing power is being artificially restrained by their government. And that's going to end, and pretty soon the Chinese are going to start to consume what they produce, and Americans are going to have to do without those things.
Well, speaking of China... Welcome back, everybody. Peter Schiff is our guest. He's the CEO and the Chief Global Strategist at Euro Pacific Capital. We started talking a little bit more about your Chinese picks and specifically the interest that you've got in foreign REITs. Why?
Well, I like the property sector, particularly commercial property. I'm not a big fan of residential property. I mean, residential real estate is pretty much overpriced anywhere in the world you want to go, particularly so in the United States. But I think there's still a lot of value in the commercial real estate market, which would be office buildings, shopping centers, industrial properties. And I'm trying to be very defensive in my investments. I do think that there are going to be some short-term negative repercussions around the world from the sharp declines I expect here in the United States. And I think when you buy these commercial REITs, you're likely to be insulated. They have very good yields. Most of them are 6, 7, 8% dividend yields. They're very consistent, and most of these property trusts do have the ability to raise their rents and are likely to raise their rents to help you be protected against global inflation.
Could you give us some specific names?
Well, sure. I mean, in Singapore, our largest position there is a company called Ascendus, which has property in Singapore. In Australia, we own Investa Property. I own Kiwi Inca Property Trust in New Zealand. We own REITs in Europe. I own one PSP Swiss Properties in Switzerland. In the Netherlands, we own a couple, Verdelhav, which actually even has a little bit of property here in the U.S., but it's mostly diversified around Europe. Another one called the Vastanet Office Properties, which again is mainly in the Netherlands.
Are all these, is there a foreign exchange exposure if you're buying these?
Of course. I mean, that's the main reason for going there, is because the dividends are in foreign currencies. If you own property in Europe, you're collecting rents in euros. If you own property in Singapore, you're collecting rent in Singapore dollars, and Australian dollars, or New Zealand dollars. And that's very important that Americans lock up income streams in foreign currencies, because when the dollar collapses, and I do expect a significant collapse in the value of the dollar, you're going to see a very dramatic increase in the cost of living here in the United States. And the way to offset that is to have income coming in foreign sources, in appreciating currencies. So now if you're paying 2 or 3 times as much for food or gasoline or health insurance, whatever it is, now your income has risen to compensate for that.
All right, let's take a break, everybody. We're going to come right back after this. We're going to have more.
I wanted to ask our guest about this today because, Peter, I know that you still like energy, particularly outside the U.S. To talk to us about why you still like some of these stocks.
Well, I mean, I happen to have a significant personal position in petroleum geoservices, as well as own it for clients, one of the stocks you just mentioned, as well as some of the Russian companies. But, I've been recommending oil and buying oil stocks for my clients since oil was in the teens. And I still see the macroeconomic forces that have driven oil from under $20 a barrel to over 70 are still in place. I think we've underinvested in exploration and development for years, And I think that, as a result, people believe that oil prices would stay low and stay plentiful. And I think we have too much consumption, not enough conservation. We didn't have enough investment. And I think you're going to see the supply and demand dynamics continue to move oil prices higher. Ultimately, though, when I think the U.S. dollar finally collapses, that will provide some relief for the rest of the world. Unfortunately, it will send oil prices to the moon for Americans. Because when the dollar collapses, that will make oil less expensive for other people, particularly in Asia, when the Asian governments finally come to their senses and let the dollar drop. But it will make oil and gasoline significantly more expensive from the point of view of the Americans. I think the price of oil could easily move to $150 to $200 a barrel for Americans.
When? What's the time frame?
Over the next few years.
What particular, we have seen quite a marked improvement in the prices for a lot of these energy companies right now. What are the particular ones that you think are still offering some value here?
Well, we've been buying, for most of our clients, we've mainly been buying a lot of the Canadian oil and gas trusts. And we love those investments. They provide significant dividend yields. We've been buying them since 1998 or 99. And generally, you can get dividend yields in the neighborhood of 12 to 18%. Most of these trusts pay dividends on a monthly basis. And I think they're still priced for oil in the 40s. So they still don't really reflect the reality of today's oil prices. There still is a lot of nervousness. Oil's been climbing a wall of worry for years, and I expect that to continue. And I think
which are the particular names of the Canadian oil companies that you like?
Well, if you want some of the names of some of the ones that actually trade in the United States, they can buy Baytex, BTE, Harvest Energy, HTE. I own these stocks myself. I've owned significantly, and I've owned them for years. There are also a number of stocks that don't trade in the United States, that only trade in Canada. And, number of these stocks that I own, when I first started buying them for clients years ago, they didn't trade in the United States either. But as they become more popular, more and more of these companies have chosen to list their shares in the United States.
How does an investor buy? You've made a lot of recommendations of companies that don't necessarily trade on U.S. exchanges. How can an individual investor, get into some of these stocks? I'm
glad you asked that, Susie. Sure. Euro Pacific Capital, what my company does is it specializes in helping individual investors to access markets all around the world. And we do so in a way that substantially reduces the transaction costs that they might otherwise encounter when they try to trade these stocks through a typical brokerage firm where they have to buy them through the pink sheets. And you get much better valuations when you stay away from these large cap ADRs.
Let's take a quick break on that note, everybody. We're going to come right back. Peter, before this news, we dipped into, listened to some of what BP executives were saying about the problems they've had in Alaska and the Prudhoe Bay area. The company, the head of their U.S. operations was talking about how they really stumbled into some of these problems. Do you think that this is something that is just BP, or is this going to develop into some kind of an industry-wide problem?
I really don't know. I would have no way of knowing. I do know that oil and gas exploration, was pretty much, absent for many, many years. That company that they mentioned that I own quite a bit of in Norway, Petroleum Geoservices, a few years ago was near bankruptcy. They're a seismic company, and they help oil companies look for oil and gas. And since everybody was convinced that oil prices were going to be low forever, nobody was buying their services, and they almost went broke. The stock was pennies. And, of course, now the situation has turned around, but, it's going to take years and years to bring on new supply. I think
but you can argue that conviction of how convinced people were that prices were going to stay at $12 forever, maybe you've gone and the pendulum has swung the other way right now.
Not yet.
Well, we'll talk a little bit more about it when we come back. We have to take this commercial break, and we'll be right back. Please stay with us. Peter Schiff is still right here in the chair with us. Peter, your outlook for interest rates here in the U.S.?
I think rates are headed a lot higher. I think right now the bond market is really focused on the wrong thing. The bond market is looking at the economic slowdown and thinking that this slowdown is somehow going to help contain inflation. Well, number one, the slowdown is going to be a lot worse than the bond market thinks. But it's not going to work to contain inflation. If anything, it's going to stoke its fires, because what's going to happen is the weakness in the U.S. economy is going to help precipitate a flight out of the dollar. And the weakening U.S. dollar is going to help propel consumer prices in the United States much higher. You see, when people are focused on recession, they're looking at the demand side of the equation. But they're forgetting about the supply side. And so even though demand by U.S. consumers is going to fall prices are still going to rise sharply.
Is this scenario, though, stagflation? I mean, if you're looking for sharply reduced growth here in the U.S. with the continuation of high levels of inflation, stagflation is what we're looking at?
Right, it's stagflation, but with a lot of stag and a lot of inflation. I mean, far worse than what we experienced during the 1970s.
The idea, though, is if you are expecting for growth to slow down so markedly over the next year, that would have to say that the Fed is likely to take rates lower in order to precipitate demand.
I don't think the currency markets are going to let the Fed do that. I do believe the Fed is going to pause for a while, but ultimately I think you're going to see a reversion of, in the bond market, you're going to see long-term rates start to head higher, and dramatically so, and eventually the Fed is going to be forced into raising rates. But I think they're going to be dragged to that. But it's really going to hurt the U.S. economy and exacerbate the recession. I think people don't understand that we're going to be in a recession where interest rates are going to rising, and that's really going to compound not only the problem for all the Americans with these adjustable rate mortgages, but our national debt. We have an $8 trillion national debt, and the federal government has an adjustable rate mortgage on that. We have very short-term paper out there that's going to be very expensive to roll over.
Let's take a break on that note, everybody. We're going to come back and finish our conversation with Peter Schiff. You're watching Open Exchange. It's 11:51 here in New York, and we're going to be right back. Sharp moves going on in the precious metals today, specifically with gold, as gold prices are down almost 3%. Our guest likes gold and silver. Peter Schiff, the CEO of global strategist with Pacific Euro Capital. Is this a buying opportunity as we see gold dropping about $16 this morning?
You bet it is. It's a great buying opportunity for gold and silver. You know, I've been buying gold and silver both personally and for my clients since silver was around $4 an ounce and since gold was under $300. You know, now you've got silver today. This morning it was up over $13. Now it's back in the 12s. Gold's over 600. I think both metals are still inexpensive and are headed higher. You know, remember the moves in the 1970s. You know, you had silver basically go from around $1 an ounce up to 50. You had gold prices moving from $35 an ounce to 850. You know, those are huge moves. I think we can repeat something like that this time around. And the same thing with oil. Remember, oil went from $3 a barrel to $30 a barrel during the 1970s. That's a tenfold increase. We're only at about a triple right now. Also, the industrial metals, we've been buying copper, nickel, lead, zinc for our clients for years, and companies that mine those metals. And I think every dip so far has been a buying opportunity. I think the technicals for gold and silver look very good. I think this is, you know, a few people getting stopped out of the market. I would buy this dip and not look back.
Why do you think such a big move this morning? $16 lower, 617. We haven't seen this level in a couple of months. What's spurring you think?
I just think it's just technical. I think you get some speculators that come in there that are very leveraged. The market was starting to look breaking out a little bit. Maybe some people got a little overly long. They laid some stops in beneath the market, and you know, now they got taken out. But I think from a long-term investor's point of view, you want to own gold. I think particularly as central banks around the world continue to debase their currencies in order to prevent the dollar from collapsing, you're finding people around the world are preferring to own real money, to own gold and silver, as opposed to money substitutes or fiat currencies.
In terms of the gold, you know, they introduced the ETF for gold. Is that something that you would advise your client to buy? Should they buy the bullion outright?
You know, when you're buying these ETFs, you are buying bullion, you know, so you're buying it through an exchange-traded fund. The only risk you really run there is that there's some fraud involved and the accounting isn't what it should be. We sell a lot of physical precious metals directly to our clients. You know, we deal a lot with the Perth Mint certificate program in Australia, which I think is an excellent way for individual investors to buy gold, silver, and platinum. They can learn about the Perth Mint program on our website. But it's a great way, inexpensive way to own metals.
All right. We thank you very much for your time today, Peter.
Thanks for having me.
Our thanks to Peter Schiff, the CEO and the Chief Global Strategist at Euro Pacific Capital. And thank you for being with us today. Hope you'll be with us tomorrow here on Open Exchange.